it's almost a complete 180. I mean, Jacksonville 15, 20 years ago was kind of overlooked, and maybe 7, 10 years ago was maybe one of the best kept secrets in Florida. But today, it's no longer a secret, and Jacksonville's a top 10 or top 20 list maker.
This episode brought to you by Suites at Madison. Meeting and conference rooms for rent by the hour, week, month, or year. Suites at Madison, where business gets done. Check them out at www.downtowntampaoffice.com. Now, on to the show.
You are listening to the Invest Florida Real Estate Show, covering topics in lending, buy and sell strategies, property management, hot markets, and tips and tools to guide you along the way on your path to real estate success. You want Florida investment real estate talk? You have come to the right place. And now, our hosts, Eric Odom and Steven Silverman.
Hello and welcome to another episode of the Invest Florida Real Estate Show. This is your co-host, Eric Odom. Flying solo this week. Steven's out of the country, taking a little much needed break. He'll be back next episode, so I know y'all look forward to that. In the meantime, we've got a really terrific guest. It's a fairly full-sized episode, so I don't want to take a lot of time in the intro here. Did want to make a quick shout-out from one of our listeners who left a review for us. It says, great podcast, good variety of guest investors and types of investments. Keep up the good work. Dan Thompson out of Sarasota. Guys, well, first off, Dan, thank you. That's great. We appreciate the time that you take to leave a note. It's actually, you left this on our website. We didn't see it, and we're just catching up to it now. But it was much appreciated. And if you guys that haven't had an opportunity to do so, if you could stop by the iTunes store or the Google Play store and leave us a review, these reviews help us a great deal, because when guests are determining whether to invest their time with us on an episode, they want to see if anybody's paying attention. And so those reviews help us a great deal. This week's guest is a great example. Guy runs, he's got 1,000 employees, and he started out just doing single family homes. And now he's got a fairly large multifamily business based out of Jacksonville. And, you know, guys like this, it's tough to get their attention. And you know, you guys help us out by telling them that it's okay to come on and that you'll pay attention. They all come on. Sometimes they just like to tell their story, and sometimes they're interested in deals, and sometimes they're interested in capital and debt. But there's always some interest in either helping investors or other that they're wanting to determine how they're going to spend their time. And you guys leaving those reviews helps out a great deal. So today, we're going to talk Jacks. We're going to talk multifamily, and I think this is going to be a show you guys are going to find really fascinating. So I won't waste a lot of time with you early, and let's go ahead and get into the show. Today, we have with us Jeff Klotz. Jeff is a serial entrepreneur, speaker, and multifamily real estate expert. As a young businessman, Klotz first gained success in the real estate industry and later became best known for his work in the private equity real estate investment space. He is the founder and operator of the Klotz Group of Companies, a vertically integrated and comprehensive private equity real estate investment platform operating in over 20 states throughout the U.S. During high school, Jeff started an investment real estate business purchasing single-family properties. The business quickly grew to a portfolio of 30 homes, and his success led to the acquisition of several supporting industries, including construction and property management. He hired more than 250 employees to service the multifamily sector and became one of the fastest growing businesses of 2000 to manage, repair, renovate, and contract for the apartment industry. The business became the third largest such company in Jacksonville, Florida. Cumulative successes have resulted in significant real estate and investment holdings with a portfolio valued at over $1 billion and an executive, corporate, and operational staff of more than 1,000 employees. Jeff's ability to formulate a paradigm that generates exponential success has earned the attention, respect, and confidence of some of the world's most prominent investors and industry leaders. Jeff, thanks so much for joining us on the Invest Florida show today.
Great. Thanks for having me. I appreciate the intro.
Yeah, and a great background. You've done a lot in a relatively young career. Talk to us a little bit about how you got into the real estate business and what captivated you.
Okay. Well, I kind of grew up during that time period where real estate investment was hot. Everybody should be a real estate investor, and everyone should own a home. I mean, pretty much the American dream was home ownership. And so I realized today that's not so much the case, but I guess you could say I tripped and fell into the investment business early in life, really in high school. I mean, I bought my first single family investment property while in high school. That itself is a bit of a unique story, but that's really what kind of got me started. And thereafter, I'd worked my butt off to save up enough money for a down payment on the next house. And I kept doing that over and over and over again until I built a portfolio of, like you said earlier, a little over 30 homes. And then I started to really understand the type of equity that I had created. And that's what really, I guess, I parlayed into the multifamily industry, which is really what I had was after, right?
Gotcha. And so when did you start in the multifamily? Like when did you make that, flip that switch to say, well, single family is great, but I'm looking at multifamily and think there might be some opportunities there too?
Well, I guess so. Shortly after high school, I started a construction business to really work on the portfolio of homes I was building, and almost immediately fell in love with the multifamily industry as a group of clients. And so I learned at an early age the efficiencies and the economies of scale in multifamily were super attractive. And I also learned that within the industry there was just a lot of waste and a lot of opportunity to just do good. And so I learned that if you could just provide a good service at a good price and pretty much do what you say you're going to do, you could grow a construction business as big as you wanted to grow it. And so, my first, I guess, foray into the multifamily industry was by way of construction as a vendor. And then that shortly thereafter led to entry into the property management business, then into the brokerage business, and then into the mortgage banking business, and so on. And so I'd say I purchased my first multifamily property in 1999. I purchased my first single family property in 1994. So it was 5 years later that I was able to really learn how to grow, I guess, my net worth or my capital or I guess my sights on a larger multifamily property. So
you got in with enough time to get some experience under your belt before the 2008 tsunami hit. So why don't you talk to us a little bit about that, like what you were thinking, when the economy started to turn and how you weathered that storm?
Well, that's interesting because I spent really the 10 years prior to that struggling as a young business owner and entrepreneur how to grow a business, right? The number one reason why small businesses just struggle or fail is lack of capital. And, I was in my early 20s during kind of that ramp up period. And so, I'm the son of a firefighter, so I didn't grow up with money or rich, and my exposure to rich folks was limited. So I really struggled to both understand how to gain both debt and equity capital as a young business owner. And so that 10-year period leading up to, we'll call it the meltdown, was really just focused on how do I do more and grow more. And so I spent much of my time focused on kind of growing the business horizontally, really growing a services business, including, brokerage, property management, construction, development, investment banking, mortgage banking, you name it, anything I could do to provide services to the multifamily industry, I learned how to do and do well in order to grow the business so I could really afford to buy more multifamily real estate. And so I really didn't know much about working with investors, or I really didn't understand sponsorship or syndication or any of those things that are kind of common practice today. Capital markets was a bit of an enigma to me. And so as kind of 2008 started to approach, I really started to open my mind and learn and educate and understand capital markets. And so in 2009, just as the market was really starting to fall apart, we decided we'd launch our first real estate fund. And so for me,
great timing. Yeah.
Yeah. Well, we at first we thought, oh my gosh, what are we doing here? And for me, the entire world was crashing down because look, I'd been in one business my entire life. I've done one thing since becoming an adult, and that was really multifamily or real estate investment. And so to some extent, I kind of thought I had life figured out, right? Every day you wake up and your property is worth more than what it was the day before. Unfortunately, in end of 2008, beginning of 2009, the whole world started to change, and property values started to plummet, and it was almost a an earth-shattering event for almost anyone in the real estate business. And so, we kind of put the launching of the real estate fund on hold late 2008, early 2009, and really focused on operations and just being the best operator that we could. I, of course, being a young business owner, I had no clue what to expect. In fact, many of my older partners who had been through several economic cycles had no clue what to expect. And so this was really a first time or a first thing for almost everybody. And so our strategy was to just hunker down and get really good at operating real estate. And we thought we could kind of defy the odds. And that really helped. I mean, our expertise in real estate operations, our ability to control all of our own resources and really control our own destiny is what allowed us to survive the recession and quickly kind of get back up on our feet and start trying to take advantage of some of the opportunity that was out there. And so late 2009, we launched our first real estate fund, and we went from buying on average between 3 to 4 apartment deals a year, roughly on average 1,000 units a year, pretty much year in, year out like clockwork over the past 10 years, consistently struggling to figure out how to do more. In 2009, I think we bought 12 pieces of real estate. 2010, I think it was 14. 2011, it was 18. 2012, it was 23. And so we went on what I'll call a pretty wild and crazy growth spurt, really growing the business from under 100 employees to over 1,000 employees in about a 24-month stretch. And we were, gobbling up as many what I would call distressed, troubled, or broken assets that we could find during the downturn. And I want to say between 2009 and 2014, really a 5-year stretch, we averaged, I think 8,100 units a year in acquisitions. And so that was a pretty wild time. Pretty interesting. It was, we were kind of thrown into the fire, forced to really figure out how to grow a business, which was interesting in itself, right? Growing a business is one thing. Learning how to manage that growth while you're growing is a whole nother story, a whole other challenge. And so, but it was a good time to be in the real estate business and growing an acquisitions business. And of course, it was our platform that during that time period, which we really perfected the synergy between, all 10 of the subsidiaries, and how they could each really support each other and really support the growth of the business as a whole. And so, we quickly built a portfolio that was, north of 30,000 apartment units and became one of the more active, what we'll call multifamily, middle market multifamily groups in the Southeast. And so it was a good lesson to learn. That's for sure. It's good stretch there. So
talk to us a little bit about, you're buying existing structure, second generation structure.
We were prior to the crash, in late 2009, we were probably doing about 75% of our business was the acquisition of existing real estate or existing multifamily property. 25% was new development. When the crash occurred, the development business was pretty much put on the shelf. You couldn't, we used to say you couldn't develop real estate during that time period if you got the land for free even. And so, from 2009 through 2015, next to no development at all what we'll call value-added repositioning of existing multifamily properties.
So talk to us a little bit about, like, you've got this fund out and it's a blind fund. Like you're not, it's not specific to the individual asset. You're actually pooling it and using it similar to a REIT. Would that be accurate?
Yes. Our first fund and actually the entire series of funds that we've launched subsequently were traditionally structured private equity type funds. So they're blind pool, commingled, discretionary cash real estate funds. So, we started out with the standard, the typical 2 and 20 structure, which I'm sure is, a lot of folks talk about. And, that kind of evolved over the years. And, since then, we've completed our 5th fund. The first fund started out at $20 million, was oversubscribed. And since then, our fund size has grown to over $100 million in size.
And where were you going to find the equity for those funds?
Wow. So we were a bunch of different ways. And so, I guess the first step was we had really set ourselves up to work with what I'll call the retail investor. And we quickly realized that probably wasn't the best route to go because it was going to be more difficult to scale working with smaller check sizes or smaller subscription amounts. And
sure.
So we, I guess, kind of through trial and error, we realized that we really needed to figure out how to become a little bit more institutional quality, And we, again, increased our minimum investment size to $250,000 with a real target of 7-figure checks. And so those came from family offices, small endowments, a lot of professional investment firms. And we worked with a lot of different investment bankers and broker-dealers to make those types of connections, as well as we had a team in-house that was both a sales team and a networking group. And, of course, the synergy from all the other different business units really pulled in a lot of interest, right?
Yeah, and once you have a track record, this is for the benefit of the listeners, and sure you understand this, but once you have a track record, you can line up the money, the equity that you need. The issue is trying to get those first few deals done. So I'm curious, 2009, Rome's burning, and you guys are rolling out your first fund. How are you explaining to the mostly retail smaller investor not to be afraid that this is really the opportunity of a lifetime, which really it was? If you're buying assets in 2009,
sure.
10, 11, you were hitting the ball out of the park. So, but how do you explain that to those retail investors that maybe are a little bit concerned, and you've not had a fund before? I mean, obviously you have a background in real estate, but not having a fund, it's still you're selling air really for that first go round. So talk us a little bit of how you explain that to people.
Right. So to some extent, you're exactly right. But we quickly, I guess, evolved early on to recognize the need to work with a more professional investor who kind of got the story right off the bat. So it was kind of interesting because we didn't have to really start into the pitch much before these investors really started smiling. And when they started realizing that we were buying, a piece of real estate for $1 that once sold for $4 or $5 or $6 or $7 or $8, even $10. If we're buying stuff 10 cents on the dollar, 15 cents on the dollar, 25 cents on the dollar. These individuals were astute and savvy enough to recognize the value in that. And it was almost, you could almost see the smile on their face grow from like a small smile to just a big, big grin, to almost like their tongues were hanging out of their mouth when they realized just how much value we were buying. When we were buying bank-owned real estate for, again, less than 10 cents on the dollar, the average investor just really, really gravitated towards that. And they really realized that when you're buying at those prices, the good news is you've got a lot of screw-up room, or you're well protected by your basis, however you want to put it. And so there was room to really regain and create a lot of value. And I think switching from the lesser experienced investor to the more experienced investor, and it didn't have to be a real estate investor. Many of our early fund investors had never really formally invested in real estate, but they had invested in a lot of other alternative assets. And so they got the discount and the value right away. It did not require much explanation.
Yeah, we've worked in some syndications before, and talking with other syndicators, it's interesting to always hear their stories as to some of the things they wish they could have a mulligan on. And, for us, part of the deal is, maybe we undervalued our own time, and there's multiple ways that you get paid out of a syndication if you're a syndicator. And so many first-time syndicators, they'll just say, well, I'll just work for equity on the back. Well, no, you can't do that, because you have to pay your bills and you have to be able to survive. And who's going to really trust you if you're sitting there living on ramen noodles like you did in college? So would you say that was, like maybe some other issues, or maybe there's one other issue or two other issues that when you got started, you go, wow, if I'd done that over again, I would do that differently. And now you're incorporating it into your funds going forward.
Well, I think, one of the things that you just kind of touched on, I'll call it the alignment of interest, right? And so you hear a lot about that, and a lot of times you hear about it with the alignment of interest in fees and structure. And it's not just about what the sponsor is getting paid, or how little the sponsor can charge, because you're right. There's a lot of value in what I'll call the emerging manager or the emerging sponsor. And a lot of investors really, they're savvy enough to seek out the investor who's newer to the business, because they know he'll work harder, he'll work faster, and he's hungrier.
Sure.
Maybe he'll work for cheaper. But at the same point in time, that investor should be, I guess, savvy enough to realize that it has to be a win-win situation, and you can't go broke, living off of ramen noodles, like you mentioned, the sponsor's got to get paid sufficiently enough to operate the business correctly, and that's pretty important. I think that we were fortunate because we had a good size infrastructure in place. We had a team in place, a lot of back office support, and all the other aspects that really are required before launching a syndication business. It's pretty difficult to launch a business with just a small team or a small office. I mean, there's a lot that goes into every aspect of whether it's fundraising, investor relations, corporate governance, back office support, accounting. And I won't even get into asset sourcing and acquisitions, and then property management operations. I mean, there's a lot that goes into it, and so setting yourself up with the right business plan and being properly funded is key to the success, because we see a lot of syndicators that end up just not having the resources available to themselves in order to properly succeed in the business that they've created. And that's a challenge. But going back to your question about what would I do differently, I mean, my story is a little bit different because we went through a period of really rapid growth. I was naive in a lot of ways, not really understanding how difficult it would be to manage that type of growth, right? And so there's, going from 100 employees to over 1,000 employees in about an 18-month stretch was a big learning curve. It was a huge growth spurt, and of course those growth spurts typically come with growth pains. And so I think if I were to do one thing differently, it would have been just to really understand how difficult it is to scale like that, and probably be a little bit more prepared. And we're doing that now, right? So fast forward past 2015, we've really evolved the business with a much different focus on what I'll call higher end luxury real estate. A lot of our real estate developments, we're heavy in development now, so a lot of our real estate developments are what I'll call best in class, and we've really proven a couple concepts out here over the last several years since the market's really improved on how to create the same types of stellar or superior returns that we were able to create during the downturn here during a totally different market. And so we're focusing on growing here today, and the lessons learned from the past growth are really helping getting us through that, right?
Yeah, and let's talk a little bit about the operations of running a syndication business. What are some of the challenges that maybe you didn't anticipate? I've heard people talk about the investor relations side of things. Maybe they didn't fund that enough because there was a lot of hand holding necessary. And what were your experiences in saying, well, man, when I started doing the syndication, I didn't really think that through properly, and now that I've got some experience, we've structured it differently?
Well, I think you just hit the nail on the head. I mean, the investor relations is key. And if it's like almost everything else in business. If you think you're going to need 10 hours as an investor per quarter, you're going to need 50 hours. And so, you almost always underestimate the need of the investor. And, every investor is important. You might have 50 or 500 investors. They're most likely only investing in a small handful of real estate sponsors. And so, being able to really hold their hand, being able to really cater to their needs, and really being able to support them, you just simply can't expect them to read the reports and understand what's going on. You've got to have a lot of one-on-one interaction. And in my experience, one of the challenging aspects, even though I've always had a great team, and I give a ton of credit to the team, I could never ever do it without the team. The check writer wants to talk to the guy whose name's on the door, and that's who he wants to hear from. And you could have chief investment officers and an entire team focused on investor relations, but at the end of the day, in my experience, if you build the right type of relationship with your investors, they really want to speak to the owner. They want to speak to the guy whose name's on the door, and there's only one of you. Or in my case, there was only one of me, and so that was very, very difficult, being pulled out of what made us great in the first place, which was a very laser focused effort on running real estate, sourcing real estate, operating real estate, and then selling real estate. Now, I quickly, back then I quickly found myself getting, the majority of my time being sucked away, pulled away by the investors, because, much like, they say a happy wife is a happy life, you got to keep your investors happy.
Yeah, it's it's obviously we experience on our end too, and it's a delicate conversation that you have to have sometimes with some of your folks that I love you, but the more time I spend with you, the less time I'm doing these other things that can make you money. So we've got to try to limit inside of this box when we talk. And we're trying to make it as efficient as possible for both of us. Those are challenging conversations for folks that tend to be a little bit more needy and want a little bit more hand holding, a little bit more data they need out of you, and more reporting, and down to the granular level of how many showings are you having on these to get this stuff leased up properly. It's tough.
I agree, and I think if you're considering the syndication business, you need to understand that the syndication business is a separate business. If the real estate business is a separate business. The property management business, I mean, there's 4 or 5 different businesses all built into one, and I think you have to really understand that and acknowledge that you're entering a new business. If you're in the restaurant business and you're opening up another location, it's a similar situation. And so I think that if you understand that, you'd be a whole heck of a lot more prepared.
Now you've talked to. They say that you're doing a lot more on the development side. Have you shut down purchasing the second generation spaces, the value add type stuff, or are you still looking and doing those types of deals also?
Oh no, we're aggressively pursuing the acquisitions of anything existing throughout the Southeast at the moment. I will tell you, it's so much harder to find deals that underwrite. In today's market, right? Sure. Everybody's chasing the same deals. And so, locating what I'll consider, appropriately priced, existing multifamily is tough. We can still do it. In fact, we've made a handful of acquisitions this year of existing real estate. But for every, one piece of second gen, or existing multifamily that we can find and purchase, we're able to buy 2 or 3 pieces of land that gets us a whole heck of a lot more excited. And so we just naturally, as a result of where we're at in the market cycle, we find ourselves leaning more towards development than the value add strategy.
Are most of your deals coming by way of broker or your independent marketing, or how are you finding deals mostly? Word of mouth?
Yeah, it's really the synergy of the platform. So while we're in our own brokerage business, and that brokerage business serves the Southeast pretty heavily, I'm consistently working with multifamily property owners, whether it's on the brokerage side, the mortgage banking side, property management side, the construction side, or the investment banking side. So, we've got an entire team that just serves the industry, and they're providing all different types of services to the industry. And so, you might be working with a client who's looking to raise some capital for his next acquisition, and next thing you know, he decides he wants to sell an asset. And so we're able to get a first look at that asset, or, we might be working on a refinance for somebody, and, all of a sudden, for whatever reason, that refinance doesn't make sense for them, or maybe a sale makes more sense, or maybe they, or we get a lot of folks that come to us looking to partner, or actually they come to us initially looking for us just to find them debt and find them some equity to make an acquisition. And at the end of the day, they might realize that they get better terms on their debt. It's easier to raise capital when they lock arms with us and really leverage our track record. And so we end up partnering and getting involved in a lot of acquisitions that way, right? Because we bring a lot of value to the table. And so a lot of times, a potential client will bring us an opportunity and say, look, I've got this great deal. I need some help getting it closed. How can you help me? And at the end of the day, our track record of buying and selling 125,000 units over the last 20 years and the results of those efforts, and, the balance sheet that we have today helps get deals closed so much quicker, easier, and with better pricing and terms. I guess you could say we loan that out a lot in order to get ourselves into these opportunities. And that's how we end up finding a lot of deals these days.
Gotcha. Let's shift gears a little bit, Jeff, and talk about market from 30,000 feet. We've been flirting with this inverted yield curve here recently, and
sure.
And some things that with some I know my contractors are complaining about some of the pricing on some of their materials that they blame on tariffs and whatnot, and maybe this is starting to ripple through the market a little bit. Just talk to us from 30,000 foot. What are you kind of seeing, and what's your posture right now in terms of your strategy?
It's really interesting, and I wish I had that crystal ball. I recently spoke on, this was maybe a month ago when the yield curve inverted. it's not the first time it's happened. And of course, that's been a big trigger or indicator of trouble in the market for a while. I call it the Trump effect because, just as, all these different indicators that really should make you scared and worried and take a more conservative or defensive posture, we keep blowing through them. And so, it's really hard. I mean, it's really hard to predict what happens next. I can tell you, the confidence in the market has never been stronger. And there's just a lot happening. And we live in a bit of a bubble here, both in Florida and the Southeast, because there's such a strong desire for, it feels like, the rest of the country to both invest here in the Southeast and even more particularly in Florida, as well as live here. And so, I think the market's strong. I'm obviously concerned and alert. We have a strategy. We like to go short almost everything. So we underwrite everything for a long-term hold, but with a short-term strategy. And so, but I feel good about the market. There's plenty of debt and equity available, and there's just a lot of great things happening in here in the Southeast and specifically in Florida.
Have there been any kind of shifts in the wind with the agency debt, the Fannie and Freddie? I suppose that's where you're getting a lot of your financing from, and probably CMBS too for your funds. So, talk to us a little bit about the debt side and what you're seeing there.
So we're pretty well balanced between Fannie, Freddie. We find ourselves doing more FHA work today when we can kind of, I guess, stomach the challenges associated with that. Not a whole lot of CMBS at the moment. Okay. That was probably more last year whenever Fannie and Freddie kind of became at capacity for a while there. We're doing a lot of LifeCo work, and so I'd say today easily Fannie and Freddie make up the bulk of either our refinance or our permanent acquisition financing choices, followed by probably a close second with FHA, and then maybe 25% of our lending on cash flowing permanent financings is done with some life insurance companies, and then of course with all the development work we're really seeking construction financing from we'll call it the top 20 commercial banks that are using balance sheet money to write those types of loans.
Gotcha. Now, we're a Florida podcast, and you're based in Florida, and definitely fortunate to have you and spend some time with us this afternoon, talk about it. But I'd be remiss if we didn't talk about why you're here and what you like about you're doing a lot in Jacksonville right now, aren't you?
Well, I love Jacksonville, born and raised in Jacksonville, or Jacksonville Beach to be exact. It's interesting because 15, 20 years ago, I'd find a great deal in Jacksonville. I'd call up a partner investor up in New York City or somewhere like that, and I'd get really excited. I'd tell him, hey, I got a great deal in Jacksonville. And he'd say, Jacksonville where? And, Jacksonville, North Carolina, Jacksonville, Arkansas. I'd say, no, silly, Jacksonville, Florida. Oh, no, I'm not interested in Jacksonville, Florida. And, today I call up the same group and I say, hey, guys, just check it in. What's on your appetite? What's on your radar for 2019? They say, hey, you got anything down in Jacksonville? And it's almost a complete 180. I mean, Jacksonville for, maybe 15, 20 years ago was just overlooked. And maybe 10 years ago was maybe one of the best kept secrets in Florida. But today it's no longer a secret, and Jacksonville's a top 10 or top 20 list maker. Almost every good list out there. It's drawing both national and international attention. It's amazing what's happened in Jacksonville. And it's really a job story. I mean, it's one of there's 2 counties in Jacksonville that are the fastest growing counties in the state.
Wage growth, job growth, yeah.
It's just amazing what the story and the excitement and the allure of Jacksonville is all about. So we are able to stay quite busy here in town, but Florida itself has just always been a great state for us. And I remember, again, 20 years ago, it was almost like the country was divided. If you lived really anything like West Texas and West was everybody headed to California and some of those southwestern states to invest, and everybody east of that West Texas, like center line of Texas, came south to southeast and really Florida. And it feels like today Florida's getting all the attention. And I read a stat the other day that said something along the lines of almost 1,100 people a day move to Florida. And it's just amazing the type of attention Florida gets on, like I said, both on a national and international level.
Yeah, and I mean, we've definitely seen it, the migration north, where Miami became that institutional that place that institutional buyers would go, and they really wouldn't roll up to Tampa, would see maybe some a little in Orlando, but not much. And definitely Tampa and Jacksonville sort of that outside. And now It's interesting to us to watch the institutional guys, and we see them from Miami, from New York, from Chicago, from Hong Kong. It doesn't really matter. And they're after that I-4 corridor. And, we correct them when they say, well, I'm after the I-4 corridor. I said, no, you're after the I-4 triangle. And they kind of look at me like, what are you talking about? I said, well, it's Tampa, Orlando, Jacksonville. Because if you can't ignore what's going on in Jackson, and you can't ignore what's going on if you draw a straight line from Tampa to Jax, because you have the villages that are going on there, and Ocala, which is going on, and there's just a big explosion that's happening in that, which we call the triangle, and then we'll show them and get out.
I took a run of the piece of property in the villages recently, and I didn't even get invited back to the second round. I mean, that's how much the market's moved there, and how I guess it's amazing what's going on there. I tell you an interesting kind of dynamic, which I probably have to be careful about. But for years, you couldn't talk to someone in Southeast Florida. You couldn't talk to somebody in Miami, Lauderdale, Boca, you name it, and convince them to come to Jacksonville. There's just no way possible. Jacksonville wasn't even in Florida in their minds. And so, but I'll tell you, I don't know, there's 25% of our staff in our corporate offices is moved north from Miami or Lauderdale. You've got a ton of what I call northern migration of just people looking to get out of Southeast Florida and come up to Jacksonville. North Florida has been kind of considered or named by many of the both Southeast, Southwest investors as kind of like the last frontier for Florida because almost everything is too pricey, too crowded. The opportunities are gone, and so it's a pretty interesting dynamic what's occurring here in Florida now with Northeast Florida being kind of on everyone's radar, I guess.
Yeah, no doubt about it. Let's talk a little bit about underwriting metrics. I'm sure you look at a lot of deals, and it's hard because the issue with real estate, people don't understand. Say, we get paid pretty well. Yeah, we get paid pretty well, but it's constantly this looking at how much time do I invest looking at something that I get nothing on, to be able to find something that I can actually make something on. And then it's the long deal cycle of trying to get it to come to, get it under contract and get it closed. But what are some of just a couple of the metrics that you're looking at right now? And I don't know what that might be. Maybe it's, look, I can't spend more than $15,000 per door on a multifamily, and that's what works for me. Or what are some of the metrics you sort of look at when you're looking at a deal, just to sort of check a couple of boxes before you go into full blown underwriting, to kind of, weed out some of the stuff that's not going to make any sense?
Well, I think, we have to add value to everything we acquire, right? And so there's got to be a story, a plan, a strategy on how you can add true and real value. And I think our definition, we have a whole team of folks that are both underwriting and acquisitions guys, and they get borderline suicidal because they can't figure out why we're not buying stuff that they think is a good deal. The reality of it is our bar is set pretty high, and we've got to create a lot of value. And so, we're underwriting these deals, but most importantly, we're really trying to use and leverage our local market expertise. So we've got, satellite offices throughout the Southeast and a lot throughout Florida. And so we really pride ourselves on having, boots on the ground, real operational experts in each of these markets where we can really spot and understand something that might be unusual or a rare opportunity to add value beyond what a lot of folks just look at. I can bump rent 3 to 5% or 7%. And so, and we really look for ways to add significant value. And so a lot of that today comes from our ability to control our own construction efforts, the cost of upgrades, rehabs, modernizations, and maybe re-amenitizations and things like that. And so we really look for, I'd use the word unique or non-typical, but there's really no secrets in this business anymore. We look for just unique ways to add value using our own resources that where others might not be able to do so. And so we've learned over the years that we can be a lot more competitive on the assets we purchase when the cost to add value is a lot less than the competition, and our ability to operate them is a lot better than the competition. So, I don't know that, it's hard for me to really discuss a couple things that we really look at. My solution to a very competitive environment was be a better operator, and reduce the cost of adding value, basically. Mm-hmm. And beyond that, I can't really discuss like cap rate or even criteria, because it's so wide and vast. But it all starts with a story, basically.
Yeah, each deal stands on its own.
It does. It has to. And so, we have various different investment partnerships, and every partner or investor has a different target or desire or return or flavor, if you want to call it that. And so I wish I could help you more there with a couple things. But I think the key is underwriting, and really, really underwriting. And it starts with a good, thorough, detailed, accurate, and transparent knowledge of exactly what the property is, right? Both economically, physically, and then of course the market itself. And so, like, none of your underwriting metrics or formulas or strategies are worth anything if you don't start with the right data and right understanding of the property going in. And that's probably one of the most difficult parts, is really understanding the real estate.
Yeah, I mean, you're looking at a lot. It sounds like you're looking at a lot of variety of assets, from second gen to development, and you can drive a truck through the differences in how to either build and or acquire and develop those two assets. With you're just turning from value add, you're flipping to doing ground up. I mean, the numbers are totally different. Like, what you look at, and of course, each submarket is different for what you look at, and so it's a lot of just peeling back the onion on each deal and trying to compare. And maybe in some you're dealing with some data that you're not totally comfortable with because you haven't worked that particular asset class or niche inside of a market. So it can be tough. I mean, the underwriting and you guys are doing a lot of different things that makes it even more challenging. So kudos to you, man.
Well, it is. And literally I could look at a deal in the morning and then just an hour later look at another deal, and there's $1 per square foot difference in rent yield to rent rate. Yeah. And so that's, and they're both of them are in Florida, right? And so that's a big spread. It's almost 100% jump in some cases. And so, you have to really, really understand the market, I guess, is the point there.
Are there other markets that you really like right now in Florida, or you just sort of take them as they come?
Well, it's hard for us to line up and compete with the rest of the world in, say, the Southeast Florida markets. Really, even Orlando and Tampa are so crowded right now. Jacksonville has got a great story, but yet there's still some folks that aren't believers, and so I think there's still a lot of opportunity in Jacksonville. Beyond that, we like a lot of the cities surrounding the hot spots, right? So, the peripheral cities around Jacksonville, Orlando, Tampa, that whole, you said the
Sure.
I-495 corridor heading even up north beyond Florida. And so a lot of the peripheral or the secondary cities are gaining a lot of momentum right now, which is really good for the rest of the state. And so we see a lot of opportunity in those areas. Now,
Jeff, if I were to ask you, is there a bottleneck in your business that if you could solve this bottleneck, it would really help move your business forward? What would that be?
Gosh, when you say that, I the first thing that comes to mind is like a case of bottles, right? And there's probably a dozen bottlenecks. That's the art, right? Is when you grow and you build a business, it's so much more than just the real estate, right? And so there's probably a lot of bottlenecks. Probably the chief and head bottleneck is me, because it's really hard to it's really hard to
delegate.
It's hard to delegate. There's the constant battle. If you want to grow and scale, you must learn to delegate. If you want something done right, you got to do it yourself. And it's really just hard to duplicate your efforts and what have you. And so, being at all places at all times is so I'd say, unfortunately, and I hate to admit it, I'm probably the bottleneck in a lot of areas. But there's probably some smaller bottlenecks throughout the company that would do a service to figure out how to resolve. And we battle that every single day, right?
Yeah. I mean, it's interesting. You and I are two of a kind in that regard. When some of my folks listen to this podcast, they will assuredly make a comment to me about, man, that guy sounds just like you in terms of, just getting in the way. If you get out of the way, we might get some of our work done. And I hate that that's the case, but it probably is true.
But it's tough, right? Because every one of, I don't know how you feel about it, but for me, every one of our investors, in their mind, they're investing not just in the organization, but in Jeff Klotz. And, it's that fiduciary duty is a serious obligation. And, we literally take that more serious than our own capital. And so, it's a big responsibility, and it's really hard for me to delegate that responsibility, that obligation, right? So, what that means is, I've got to really keep my finger on the pulse, and because at the end of the day, somebody else's mistake is my fault, and so it's important that, and that's something that, as a business owner, I haven't really figured out how to overcome, to be honest with you. I mean, part of me thinks that's what makes me a good investment risk, but again, part of me realizes that's going to be a challenge when, as we continue to grow. I mean, our portfolio value's been, north of $1 billion. And, we have, aspirations and desires and goals to grow well north of that. And so, that's obviously something that I've got to overcome. And look, I like to think I'm still young, even though I don't feel young anymore. And so hopefully I can learn more every day.
Jeff, it's been awesome talking to you today. If folks have deals or they want to, talk to you about maybe investing with you, how is the best way for them to try to reach out to you and your organization?
So I guess you can start at the website. One of the main websites is theklotzcompanies.com. So that's TheKlotzCompanies.com. My email address is jklotz@theklotzcompanies.com. And look, I love, for me, the multifamily industry, and specifically the real estate investment industry, was the best thing that ever happened to me. And I love introducing people to the industry. I love helping people out in the industry. And I think that there's no better way in the world, at least not that I know of, to grow and gain wealth than what I'll call investment real estate, and specifically multifamily investment real estate.
Jeff, it's been terrific, man. Really appreciate you taking the time to talk to us. I know how hectic your schedule is, and it's been terrific.
Hey, this has been fun for me. I enjoyed speaking with you, and I hope to speak to you again soon.
All right, buddy. And that was Jeff Klotz talking multifamily, talking the I-4 triangle from Tampa, Orlando, Jacksonville. He really likes that Jacksonville market. He's got investments all over the Southeast, but really likes this the Northwest Florida market a lot. There's a lot to like about it. Interesting cat. The fact that he started out doing multifamily and has grown this integrated firm with everything from property management to construction services. It's really quite amazing what he's done. He's a relatively young guy, certainly younger than I am, and definitely younger than Steven by a lot. But he's accomplished a lot in a relatively short period of time, and it's great to have guys like Jeff on, that can share with us how they got started and what they're doing and what some of their trials and tribulations are. It kind of opens a little bit of a perspective on that size of operating firm, and we certainly appreciate Jeff and the time that he took to talk to us today, guys. As always, there are lots of great guests that have come on this show in the past, and you can find them at www.investfloridashow.com. It's a great wealth it's an encyclopedia of information there. We've got almost 200 episodes there now, and anything you want to know from all corners of the state and all types of asset classes. So we hope that you enjoyed listening to Jeff today, and that you'll take the time to go check out some of our past guests, because we think we've got a pretty good library there. Next episode, Stephen will be back, and we've got another great guest for you, and looking forward to meeting with them. So guys, until next time, hasta la vista.
You've just listened to the Invest Florida podcast with Eric Odom and Steven Silverman. Join us every week for actionable real estate investment ideas, and of course, visit our website at www.investfloridashow.com for more shows and tips on how to earn a cash flow in the real estate market in Florida. While hosts and producers of the Invest Florida show have no reason to doubt the validity of comments of our guests, we do not warranty their accuracy. Please check with your legal, financial, and tax advisors before entering into any investment. Returns will vary from person to person and deal to deal based on unique circumstances. All information expressed in this show is for educational purposes only. Opinions of the guests are not necessarily shared by the hosts and producers of the Invest Florida show.